Hey guys, Davis here. So in this video, I'm going to share with you in my experience the top 3 safest option strategies that you can use to profit from a market crash. So the very first option strategy is the cash secure put. So this is where you get paid while waiting to buy your favorite stock at your desired price. And the reason you get paid is because you are selling premium. So when you're selling a put option, when you're selling options, you collect premium. And it is a much better way than the traditional way of placing buy limit order. So normally if you want to go buy a stock, you want to long a stock, you would just place a buy limit order. But this is much better, and I'm going to give you a visual illustration of what I mean. So let's say that there is this stock right now that is around $108.95, right? And you say to yourself, I like this stock, but it's a little bit pricey, but I want to buy at $100. So the first method would be to just simply place a buy limit order of 100 shares at $100, and then you just wait for the stock to go down. If it goes down to $100, you get filled. All right. So if the price goes up from here, well, you don't get filled. And if the price goes down to $100, you get filled, and then your total cost is $100 times 100 shares. That is $10,000. So this is the very traditional way that you would normally use if you want to go and buy a stock. Now, the next method, instead of just placing a buy limit order, what you could do instead is to sell a cash secure put at the 100 strike price and collect some premium. Right, so you go to your brokerage software and you take a look at the option chain, and you see that at the strike of $100, you can roughly get about $2.49, $2.50 probably. So you sell it and then you get a credit of $250. So what happens at expiration? So if at expiration price is above $100, then the option expires worthless and you keep $250. If you were to just place a buy limit order, then you won't get filled at all. You don't even get paid any money. So in this case, you actually get $250 just by waiting until the price comes down to your strike price. Now, if at expiration the price is below $100, then your option is exercised and you own the stock at $100, and you still get to keep the $250, right? So that means the effective cost of you buying the stock at $100 is actually only $9,750. So in essence, you bought the stock at $97.50. So as you can see, this is a better way for you to buy a stock, rather than if you were to just place a buy limit order and you get nothing if it doesn't come down to your level. So when do you want to sell cash secure put? Well, obviously when the market is dropping. You want to sell it when the market is dropping because that's the time when the volatility will increase. And option pricing increases, the price increases when volatility is high. That means that you get higher premiums. Now, you also only want to sell the cash secure put on fundamentally strong stocks or ETFs that you want to own and hold for a long time, because ultimately a cash secure put is still just an investment tool for you to invest in the market. At the end of the day, you still need to find stocks that are strong, they are fundamentally strong, that you know that in the long run it will go up in price. And especially right now where the market is in a bear market, the Fed is increasing the interest rate, you want to find stocks that are profitable, because in the long run, if stocks are not profitable, chances are that the stock will either not recover or it may even go bankrupt. So it's very important for you to find stocks that is fundamentally strong. And what I mean by that is generally, you want to look for stocks that have increasing revenue, increasing profit, they have very high, lots of cash. But if you're not sure how to find these stocks, the other way is that you can use on broad-based ETFs, right? You can use on ETFs like the Spiders, QQQs, IWM. That is if you have enough cash, right? Because you need to buy 100 shares of the stock with one option. So you can go for also the cheaper ETFs, like for example the XLF, which is the financial ETF, or XLK, which is the technology sector ETF for the Spiders. So those are much more affordable. So you need to definitely have enough cash to buy the 100 shares of stock in case your put gets exercised. So let's say if you want to buy Nike at $100, you need $10,000 to buy 100 shares of Nike. And another thing you want to do is you want to ensure that before you sell the cash secure put, you want to see whether that cash secure put actually gives you enough premium, right? So you're looking at roughly around 20% return on investment. So for example, if you sell a Nike put at 100 strike for $2.50 with a days to expiration of 30 days. So the ROI is simply calculated by the premium that you collected, which is $250 for 100 shares. You divide it by the cost of owning 100 shares, which is $10,000, and you divide it by 30 days, which is the option's lifespan, days to expiration, and you times it by 360 trading days, and you annualize it. This is you have annualized it with a return of 30%. So it's actually not bad. So you want to make sure that you are selling this cash secure put and getting enough premium. And if let's say you are selling a put, you are selling the cash secure put, but you're only collecting like 10% premium at the strike price that you wish to enter the stock at, it just means that the stock hasn't dropped enough for you to sell the cash secure put. So in this case, you don't want to force yourself to sell the cash secure put. You just wait until the stock drops a little bit more, and then you sell the cash secure put to get the desired premium, the returns that you want. All right. Option strategy 2 is the bear put spread. Now this is a debit spread. That means you're going to pay money for it. So a bear put spread, how it works is simply by buying an at the money put, right? So in this case, it is around the 101, 102, and you're selling an out of the money put. So in this case is roughly around 95. So you can see the example that I have here, that you're buying the 101 strike and you're selling the 95 strike. So this is a 6-point wide vertical spread. So if you were to take a look at the graph, you can see that this is how much you would make or lose depending on where the price is at expiration. So let's say the expiration, if the price of this stock is above $101, then you will realize the max loss of this strategy, which is what you paid for, which is $2.18, which is $218. So anything above $101 at expiration, you will lose whatever you paid for. But if the price was to drop below $95, then you would make the max profit of $382. Even though if it goes to $90 or below, you will still make the max profit of $382 because you have kept yourself by selling the 95 out of the money put option. So your profit really is just the difference between these two strikes. And in between, this is how much you will make or lose depending on where the stock is at expiration. So very simple, very straightforward. So when do you want to use the bear put spread? Well, it's right now as the market is dropping. This is the best time to use a bear put spread because you want to use it in a downtrend. So a downtrend is basically where you see the market is making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. So this is a downtrend, and I want to look for the times when the market has retraced a little bit back up, right? And then it is also overbought on the stochastics. So this is the stochastics oscillator. So I will look for the overbought as well as the retracement to find points where I can buy the bear put spread. So you can see down here, this is one instance, there's another instance down here, and another down here, and as you can see, it is quite reliable because we are in a downtrend. The market wants to move down, especially right now. So right now at this time of recording, this is the spiders. It has not reached the overbought area yet, but we can see that if the market was to go up to around 400, maybe even 410, where the moving average you can see is coming down, there should be some form of resistance around here. And if at that point the oscillator is overbought, then it will be a good time for you to buy a bear put spread. So that's how I would use a bear put spread. Alright, option strategy 3 is the put ratio spread. Now the put ratio spread is a combination of the two strategies I just shared with you, and that is the bear put spread and the cash secure put. So how this two works is that the bear put spread is a debit spread, so you're paying money for it, but then you are financing it by selling a cash secure put, so you actually do not pay for the bear put spread. So let's take a look at an example, right? So let's just say the bear put spread just now that we looked at, we have to pay $2.18 for it. All right, we had to, out of our pocket, $218, and then we sell a cash secure put. And by selling the cash secure put, we receive a premium of $2.44. So net, we receive a credit of 26 cents, which is $26. So in essence, we are not paying for the bear put spread. So it is a spread where you can make money on the downside, and then once you get filled, right? The whole idea here is that you want to go long the stock. And when you're long the stock, you can wait for the market to go back up, and then you profit from there as well. So this is a fantastic way to long stock. Now, you might be asking that, I've just shared with you the cash secure put. So you might be wondering what's the difference between the cash secure put and the put ratio spread, because the cash secure put is also a way for you to get long stock and you get paid for it. All right, so I'm going to share with you an illustration so you can see this much better, and what's the difference between the put ratio spread and the cash secure put. So this is the chart of Nike. So Nike has dropped quite a bit, and now it's around $101. And then you might be thinking to yourself, you say that, hey, Nike is a fundamentally good stock. I like this stock, but it's a little bit expensive right now. I want to buy Nike at $95. All right, so there are two options that you could do. So first of all, I'm going to zoom in so you can take a look at this chart much better as to how the put ratio is going to be constructed later on. So the first option is that you can sell a cash secure put at a strike of 95 for $2.44. So in this case, you're collecting $244 in credit. So if at expiration, Nike was to be above the strike price, above $95, well, you keep $244. Straightforward, very simple. And if expiration, if Nike is below $95, then your effective cost is basically $92.56, because at that point, if it expires below $95, you're obligated to buy 100 shares of Nike at $95. So when you're long the shares at $95, you can offset it with the credit that you've received. That makes your effective cost $92.56. So you want to remember this number. Now I'm going to compare this with the put ratio spread. So the second option is, instead of selling a cash secure put, you sell the put ratio at the strike of 101/95 for a credit of 26 cents, which you receive $26. All right, let's look at this on the charts. So again, the put ratio consists of two strategies, which is selling a cash secure put. So in this case, you sell a cash secure put at the 95 strike price, and then you use the money which you received, which is $2.44, which you receive for the credit, and then you use it to buy the bear put spread. So you can see, if you buy the bear put spread, you buy at the strike of 101 to 95 down here. So anywhere within this zone is your profit zone. You've already used the credit that you've received from the cash secure put to buy this bear put spread. So this is a free bear put spread. As long as the market was to drop below here, it is all profit for you. All right. So if at expiration, if Nike is above $101, let's say the market bounces back up from here, well, you only get to keep $26. So this is the graph of the put ratio spread. So luckily for us, we can just easily open up our brokerage platform. In this case, this is Thinkorswim. And you can just plot out the spread down here, and you can see your P&L chart. So from here, you can see that if Nike is above $101, anything above here, you just get to keep the credit, $26. And if at expiration, Nike is in between 95 to 101, then this is how much you stand to make, depending on where it ends, where it closes at expiration date, right? So let's say at expiration, Nike is $97. So at $97, you get to keep $427, right? So this $427 comes from, number one, you get to keep the premium from the $26 which you received upon selling this put ratio. You also get the profit and loss from the bull put spread, and then you get to keep the $2.44 from the credit that you sold the cash secured put. But of course, you do not have to do all these calculations yourself, right? So you don't have to worry about that, because the charting platform will be able to tell you your profit. So at this point of time, if it expires at $97, then your profit is $427. Now, what if expiration Nike is below $95? Now you do not really have to worry too much about this, because this just tells you your effective P&L once you are long the stock. So once you're long the stock at $95, you would have realized all this profit down here. The full 6 points that you made from the bear put spread, as well as the credit that you received by selling this put ratio spread. So if you would calculate everything, your effective cost for buying the $95, the stock at $95, will be $95 minus the total credit you receive is $6.26, which makes your effective cost $88.74. Now, if you recall, the effective cost for selling a cash secured put at $95 is only $92 something, right? So it is about a $3 to $4 difference. So a put ratio spread can help you get your stock at a bigger discount. That is why I really like the put ratio spread as a way to enter into the stock that I do want to buy and hold for a long term. It is so much more powerful, especially right now as the market is crashing. So you might be wondering to yourself, which is better? Well, there isn't one that is better, because it really comes down to just your personal preference and what the market does. Because let's say, for example, you sold a put ratio spread, right? You're thinking that you're gonna get your stock at a very huge discount. But what happens if once you put the put ratio spread, the market goes up and it never comes back down, right? Then in this case, all you have kept is only $26. That's just the premium you got from selling this put ratio. But had you sold the cash secured put, you would have collected the premium of $2.44, which is $244. That is almost 10 times more than the credit that you received here, right? So as you can see, this is a give and take, right? So you never know which is better until it reaches the expiration date. But my thinking is that I'm using this strategy as a way to enter into the stocks that I want to buy. So I do want my options to actually get exercised. And if I want it to get exercised, then it's better for me that the stock actually goes below my strike price. And in this case, if it does, the put ratio will give me a much better cost. Now, one more thing I want to mention is that what happens if your stock actually expires somewhere in between here? So if your stock expires somewhere in between $95 to $101, you will collect the profit, all right, from closing out this the full position, right? Once you got the profit, you are still not long the stock, because it never go past your 95 strike price. So at this point, you have this money, and then you can open another put ratio spread, right? You can open another put ratio spread at 95 strike as well, or you can just simply sell a cash secured put then, right? So there is quite a bit of a flexibility. So that is why I like the put ratio spread a lot when I'm really when I want to buy the underlying stock. Alright, so I hope this video has been really useful for you. If you really like this video, please give me a thumbs up on this video, and also do subscribe for more videos like this, and I'll see you in the next video.